Hello, welcome to another Fund Society Investment Summit. Good morning to our guest from the Americas. Buenas tardes a los que se conectan desde España. So today we're going to talk with IM Global Partners and their partners Scharf and Polen about where to find quality within the growth and value strategies. So before I introduce you to my guest, which is actually here with me at the studio, I want to remind everybody that you can post questions anytime during the event. You can do it through the WebEx platform and send us a question, or you can just send an email to info@fundsociety.com. The questions can be either in English or in Spanish. So today I have here with me Luis Solorzano, Head of Distribution for LATAM and US Offshore for IM Global Partners. Hi, Luis. How are you?
Hi, Elena. How are you today? Good morning, everybody. It's a real pleasure to be with you here on the first virtual summit with IM Global Partner, alongside our partners, Scharf Investments and Polen Capital. As the brief introduction, I don't know if we can start the slides or
Yeah.
So before we begin the conversation, what we want to focus today on is really Polen and Scharf's outlook on the markets right now and how quality can deliver an outperformance, whether it's value or whether it's growth. But to give a brief introduction on who we are, IM Global Partner, we're a worldwide asset management network, and what we're really trying to do is find best-in-class boutiques across different asset classes who have a proven track record of outperformance, and really being able to partner with them and offer their strategy and their solutions to different clients throughout offshore LATAM and throughout the globe. To give it a brief introduction on our first partner. As you can see on this slide, a history of what we've been doing. We launched in 2013. Currently, we manage around $37 billion in assets under management. The first partner that we embarked this journey on with was Polen Capital in 2015. At that moment in time, they had $7.6 billion in assets under management. As many of you know, they've grown substantially, and currently they have around $61 billion in assets under management. We later acquired Dolan McInerney in 2016, and in 2019, we acquired a stake in Scharf Investments, who's the other partner we have on the line here today. As we can see on the next slide, to give a brief introduction on who Scharf and Polen Capital are. Scharf was founded in 1983, and it has more than 25 years of investment management experience, and currently they manage around $4.3 billion in assets under management. Scharf Investments implements a fundamental value bottom-up approach with a concentrated portfolio of 25 to 35 names. And what they try to really see is companies with a large valuation discount, high earnings predictability, and solid growth that will be able to perform over investment cycles over the long term. What's interesting is that its approach is very similar to what we can see in Polen Capital in the next slide, that Polen Capital has the same approach, but with growth, being a bottom-up concentrated portfolio, also focusing on quality, but with more of a growth tilt than Scharf, which is value. So I think Eric's on the line, and I think he's going to begin the conversation from Scharf's perspective, and then we'll have Andrew continue from there on Polen.
Great. Well, thanks, Luis. Thanks, Elena. It's great to be here. Thanks for all that are attending. My name is Eric Lynch. I'm a managing director on the investment committee at Scharf Investments. Excuse the sun rising here in Los Gatos, California, on my face here. But what I'd like to do is just kind of outline first, just quickly, what we think that the case for quality is. So I'm not sure if we can show that first slide or not, if we're showing it. So if we can look at the next slide, please. I think, winter is still coming, right? Even though it's sunny outside, I think too many investors are confusing the strength of the economy going forward with kind of lagging indicators like employment and GDP, when really what we need to be more concerned with is obviously forward-looking indicators. And so if you look at a shortcut to leading indicators, the Conference Board LEI is now in its 13th month of contraction. So this is 10 indicators. They are non-financial and financial, but effectively that is continuing to roll over. So while employment looks great, it is slowing. credit's contracting. And if you look at this chart, you see we haven't had a real recession since really the financial crisis. And so we don't think the business cycle is dead. It is typically a phenomenon where investment is conducted with increasingly lower marginal kind of rates of returns. And I don't think this will be any different. In this case, right now, we've got credit contraction already occurring due to the banking crisis and even predating that. We've got a year-over-year reduction in the money supply. We've got a host of other kind of roll-off of fiscal and monetary stimulus. So our opinion is that investors need to be more forward-thinking, and that indeed it's likely that the economy will continue to slow. Next slide, please. And you're already seeing this. We already are in a mild earnings recession. And so Q4 in the US, S&P 500 earnings were down about 5%. And Q1, they were down low single digits. And consensus estimates for Q2 are still about -6. And what gives us pause is that if you look at this lower right-hand graph, this shows the net profit margin for the S&P 500 since roughly 2000. And so you see this long-term kind of secular improvement in that margin. And that's from a host of kind of secular things as well as cyclical. In terms of secular, you had low interest expense, right? We estimate that was responsible for 40% of the expansion of the net profit margins. You had globalization, reducing labor costs. You had lower supply costs, lower input costs. You had lower transportation costs, lower energy costs. So all sorts of things were improving that. And then finally, margins went hyperbolic in the pandemic because companies were able to pass on price. And what's interesting is going forward, consensus estimates are still including or assuming an 11% plus net profit margin, which would still be an order of magnitude greater than anything that we had pre-pandemic. So if you look at the guidance, if you read the tea leaves for what companies have been reporting from the Q1 earnings for season, they basically have been guiding down margins. And you see it in inflationary pressures, right? Where core inflation has been really stuck at kind of 4 to 5%, depending on which metric you want to use, for about 6 months, whereas headline inflation has actually almost halved. And that's really because of labor costs have remained elevated. So our opinion is that the Fed is not going to be able to retract interest rates quickly. In fact, just on a monthly basis, the Fed funds futures market is now assuming 50 basis points higher year-end 23 Fed funds rate than it did a month ago because of these stronger employment metrics. So our opinion is that the Fed will probably have to keep at least pause versus reduction, and that's going to put pressure on the economy, and things will probably roll over, which is a good segue to Andrew, because he's going to show us some data that what actually starts working in that part of the business cycle is quality. So I don't know if Andrew, you want to take over here and kind of review kind of quality's relative performance over the business cycle.
Folks can hear me?
Yes.
Yeah.
It is. Okay. All right. I was talking there. I just wanted to make sure. So no, thank you for that great segue, Eric. And again, I just want to reiterate my thanks for folks joining today. Eric did a great job of really outlining the here and now and some of the concerns maybe we have when we look forward on leading economic indicators. What I'll attempt to do, and I think it'll be helpful to maybe pull up the slide, is kind of zoom us out and offer a perspective on the very long term and when you do tend to see with this framing around why quality, when quality tends to lead. And what you see, this chart here is cumulative relative performance for the MSCI USA Quality Index versus the broad MSCI USA Index, again, going back to 1975. And immediately you take away that quality wins relative to the broad index. And I don't think that's much of a surprise to folks. But what equally is important in looking at this slide is you kind of see the color-coded periods from early, mid, late cycle, and then recessionary time frames. And what really stands out is that quality particularly wins in these latter parts of the economic cycle, and then really as you get into recession. So again, these dark blue periods within the chart here, as well as the orange periods in recession. And maybe if we flip to the next slide, I think I'll just put a finer point on that. Um, Again, so this is really just taking the chart and putting it in bar form, isolating those periods that classify as later in the economic cycle as well as recession. And you can see almost categorically that quality tends to outperform, and really as you get into recession, it tends to win. And I think just to connect it to growth, because speaking from Polen Capital's perspective, if we go to the next slide, I think this will kind of help bring things all the way around. What you'll see here is that last year, and the phrase "we live in interesting times" is probably the biggest understatement you could ever make of what we've just lived through for the past several years. But in many regards, what we lived through last year with the Fed having this historic rate hike cycle, what ended up doing was really disconnecting these longer term trends around quality outperforming, and at least over the past decade, growth outperforming. And last year, you saw growth decidedly underperforming alongside quality factors like profitability and leverage. And so we think when you put those two things together, this historical framework around quality tending to win in the later part of the cycle or in recession, as we think we are at that point today, and then growth in quality having had challenges over the more recent past, we think it's an interesting time to be considering those factors and as we look ahead. So I'll stop there and turn it back to you guys. Louis, I don't know if there's any transition you want to make. I'm good with the.
Ah, okay. Eric, I think this next slide is yours. No?
Sure. Yeah. If you could just perhaps show it on the screen here. Happy to segue now. How Scharf Investments employs a quality value tilt. And so, Andrew was really saying, if you think about it, is once you hit kind of late economic cycle when earnings start deteriorating, and then you hit recession where earnings are just in straight out contraction mode, there is a flight to quality. And what's quality? Quality is really the resilience of a company's operating fundamentals. And so we define quality as the low volatility to earnings. And so we measure it by the company's standard deviation to earnings per share over an economic cycle. And what we're trying to do is basically distill thousands of stocks into a sub-universe of those that are in the top decile for low earnings volatility over an economic cycle. And we can obviously assume from that, if past is prologue, that these are businesses that have low GDP correlation. And so when the economy contracts, they're still delivering their earnings, in a resilient fashion, and they're even growing their earnings. And so that's what differentiates us from other value investors. We look for defensibility of earnings. As we know, most traditional value is over-indexed to more cyclical factors that are, while cheap on a valuation basis, they tend to have higher earnings volatility, and they're over-indexed to things like energy, financials, banks specifically, large weights and value benchmarks for that. But just industrials, consumer discretionary, all sorts of things that the timing of the purchase and the exit are really important, and investors can really lose a lot of money if they mistime that. So that's what we do, and then we try to marry that low volatility earnings with traditional value discounts. And so we look for stocks that have 30% upside to kind of a base case scenario, and just 10% downside to a bear case scenario. That's a 3-to-1 handicaps the odds just in case we're wrong. And all stocks that are included in the portfolio have to meet that threshold. And we use that favorability ratio to make portfolio decisions, both in the purchase, but as well as trimming, adding, and selling. Because it's very difficult to marry companies that have low earnings volatility and consistency through an economic cycle at really cheap valuations, there just aren't a lot of stocks, right, that fit that criteria. And so we have a concentrated portfolio of about 25 stocks. Our claim to fame is by doing that, we're really protecting on the downside. A, earnings resilience is stronger, and B, the multiples have already been compressed. And so when the economy and the markets invariably contract at some point, and they will, then our portfolio tends to do much better. Next slide, please. And so this is actually evidenced here in this chart, which shows Scharf's 3-year historical earnings per share growth versus the S&P 500 and the Russell 1000 value. And you can see in the last 20-some years, the gold line there being Scharf, very consistent, tighter range of outcomes for that earnings growth by intention, because we're looking for those businesses that are non-GDP correlated. And so you'll see there that, even in the low case scenario, we're typically at 10% or higher, whereas the benchmarks are really going in low single digits, if not even negative, in the case of the Russell 1000 value during the financial crisis, also during the tech bubble, and then also during the earnings recession of 15, 16, 17. And that is, in fact, what we're still doing today, which we still have a very high level. We'll talk about portfolio positioning in a second. But just to put it in perspective, the stocks we're holding now, their earnings actually grew 10% in calendar year 2000, which is pretty remarkable given that the world stopped and the S&P 500 earnings, despite having a large overweight towards mega cap IT, which was producing still strong earnings and a digitization of consumer behavior that year, the S&P 500 earnings were still down 15%. The Russell 1000 value earnings were down actually 28%. So you'll see that earnings resilience characteristic of Scharf is quite differentiating. Next slide, please. And in getting back to this idea of defensiveness, our largest allocation currently is healthcare, 26% roughly. We're also have large positions in staples. It's really more important to see what we don't own. We don't own any energy. We don't own any banks. We don't own much consumer discretionary. So just as I was saying, we tend to be over-indexed to defensive sectors, under-indexed to cyclicality. We still looking at really good earnings growth, and that's consensus there, 13% for the next 5 years. Strong returns on capital, a very compelling PE, given the high earnings resilience of these businesses. Next slide. And again, I think what differentiates us now and really speaks to our quality orientation and why we feel like we're better positioned towards other value managers in the benchmark is this defensiveness of the portfolio. And I would note that we don't own any banks because banks don't fit that low GDP correlation metric that I outlined previously. Banks are great until they're not. And at this point, when we look at the US banking sector, there's still a tremendous amount of exposure of unrealized losses on the hold to maturity balance sheets of these regional banks especially. And it's a pretty high percentage of tangible equity still. So our opinion is that, that coupled with their exposure to maturing debt for commercial real estate just makes it a sector that it just has too high a range of outcomes for us. And so we're just not going to have exposure to it. But that really speaks to how we employ quality. And, in that regard, that's, I think we're very similar to Polen. I started my career at Polen. Both firms really employ an extremely high focus on quality of earnings and quality of growth of earnings for Polen's case. And I think Andrew's going to outline Polen's approach further. Andrew?
Great. Thank you, Eric. So if you wouldn't mind teeing up the next set of slides for Polen, I think it'll help kind of illustrate some of the points that I'll make here. If we flip forward, maybe even another slide, I think it'll it'll help. So just to level set with Eric did a great job, and credit to him for teeing me up here on how Poland invests. Very similar to Sharp in the sense we're looking for concentrated portfolios of what we would argue are among the highest quality businesses in the world, owning them over the long term, and really seeking for these businesses to deliver mid-teens earnings growth, with the view that if we can achieve that mid-teens earnings growth, the stock price will follow over the long term. And if you deliver that outcome, inevitably that's a good outcome for clients in an absolute sense, but in a relative sense against it, pick your benchmark, the Russell 1000 growth or the S&P 500, that should also deliver a great outcome there. And so when we talk about quality, I'm very mindful. Eric did a good job talking about earnings stability. As it relates to us, we are very intentional around what does quality mean, and we refer to this as our guardrail framework for investing in companies. And there's 5 rungs on the guardrails that really narrow this very broad universe down to a small subset of companies that we consider to be among the most competitively advantaged companies in the world. And so, what are those elements of quality? We're talking about companies with strong balance sheets, often with little debt, if not net cash balance sheets. We're talking about companies that have had a history of high organic growth that's been sustainable through time. Talking about high and sustainable returns on the business, returns on capital, abundant free cash flow, and stable to improving margins. And these, taken together, is really what constitutes high quality for us. Any one of these would constitute a high hurdle for most companies, but when you really put it together, it really elevates the level of the quality that we're looking for in our portfolios. Maybe you should flip forward to the next slide. So this slide illustrates, on a year-by-year snapshot basis, a 5-year rolling average earnings per share that our companies in our portfolio have been able to deliver, earnings growth, I should say, have been able to deliver through time. And the blue bar is the focused growth approach that I'm referencing here. And you see it against the Russell 1000 growth and the S&P 500. And what really strikes you is that with this view around the guardrails, with this emphasis on sustainable growth through time on the back of strong competitive advantages in these globally dominant businesses, what ends up typically happening, if done right, is these companies have the ability to sustain a high level of earnings growth, often longer than the market appreciates. And so you see that not only over the course of this long chart, but you see it through more challenging periods as well. You go back to the global financial crisis era back in the 08-09 timeframe. You see even then still delivering earnings growth in the realm of 10 to 15%. And so it really has hovered in that, call it, 10% to, at the higher end, 15+% range through time. And as we stand here today on the back of the year that we saw in 2022, what we're excited about is that the earnings recession effectively for many of these larger companies, think Amazon is one of the great examples here. They really experienced a lot of the pressure from kind of this grow over effect of the pull forward demand that they saw during the pandemic, and a lot of the investments that they made last year and continue to make around kind of growing their infrastructure. They're coming. They experienced that last year, and they're coming on the backside of it this year. So as we move through the balance of this year, you should continue to see earnings growth accelerate, and these companies that maybe had more of a challenging year, and we'd argue more temporary challenges around this grow over dynamic, should continue to see strong earnings growth through the balance of this year and as we look ahead. So an interesting kind of nuanced dynamic for a subset of the universe that we consider to be among the most highly competitively advantaged businesses. So I'll pause there. Actually, I guess maybe the last point I'll make, given the comments Eric made around banks and financials broadly, with our universe, admittedly, banks are not a big piece. It's a very small piece if we're talking about the Russell 1000 growth in particular. Financials are an area that we do have exposure to, but it's companies like Visa, MasterCard, PayPal that tend to fit the profile that I've been describing here. And banks are something that effectively we haven't had exposure to through our history, for not being able to meet the guardrails that I described earlier. So I'll stop there and turn it back to you, Luis.
We can go to the next slide.
We have performance.
Get the otros slides.
I don't know if you guys want to add anything to the. We have a few slides, but it's more about performance. I don't know if you want to add anything, or maybe we can move to questions.
There's another part I would like to highlight, Elena.
Okay, sure.
I don't know if we
go
can
ahead.
if we can fast forward a couple of slides. So something we'd like to highlight is, as we work with different managers, we also want to offer our clients the possibility of looking into having one, two, or more of our products within their same portfolio, and how that actually might add, a benefit in with regards to performance or to volatility. And the beauty of having both of these managers who have a long track record is that we can actually pair a portfolio of 50% Polen, 50% Scharf, and see how it would have done in the long term. As we can see on the left-hand side in the upper corner, we can see the orange line, which is this this combined portfolio versus the S&P 500. And as time goes by, we can see that the gap between the orange line and the blue line actually grows. And over different cycles, if we had both within the portfolio, then it would have actually outperformed. I believe a lot of analysts, fund selectors focus many times on value versus growth, and it might not always have to be the case of switching between one and the other. When you have two managers who focus on quality companies, on quality portfolios of concentrated portfolios with quality companies who are going to be defensive and outperform over the long term. If we can see on the right hand side, we can see that there's actually an outperformance of 11% versus an 8.7% since annualized returns since 1986, and we can also see that the volatility is also lower. So even though in individual periods a combined portfolio might underperform the market, we believe over the long term we might not have to choose between one style or the other if we have two managers who actually are great at picking these companies, these gems, who will withstand different cycles. If we go to the next slide, Elena, we can also see that the batting average is quite good, and we also see that the upside capture is 92% and the downside capture is 72%. Over the long term as well, we see that the rolling 3-year performance would actually be higher than the S&P 500, having this combined portfolio within clients' allocation. Yeah, and this slide just shows a correlation of 3-year excess returns of Scharf and Polen. And really what we just wanted to highlight here is, we have these active managers who have a very similar process, one in growth, one in value, but they do offer this, this defensiveness, this outperformance over the long term. And for sure, it doesn't have to be a 50-50, but you could have different percentages of allocation. But we do believe that, by choosing these managers that we work with, we could add some value, for sure. Thank you.
Thank you, guys. So we have a couple of questions from the audience, because this is pretty interesting, because at the end of the day, growth value, their strategies that are quite opposite with each other. So we have a question about technology. If you can give your own perspective to semiconductors and a little bit about tech companies.
Sure, I'm happy to take this, and Eric, feel free to jump in if you want as well. So I'm going to take a wild guess that this question is pointing in the direction of a lot of the AI conversation that's been so central to, I think, a lot of market commentary lately, and more specifically, a company that's found itself at the center of that is NVIDIA, maker of graphics processing cards that has historically played more into the gaming sector, but in recent years has played more into the data center space, and really kind of, for lack of a better way to put it, sells the picks and shovels for enabling some of the large language models associated with AI. So I want to disentangle tech from some of the focus that we've seen more broadly around AI. When we talk about a number of the names in our portfolio today, I didn't really get into it, but if we go to, I don't know if I have, we don't need to go back to the slide, but when we talk about technology, we invest across a spectrum of what we call safety and growth companies. And so over the past, say 2 years or so, really coming out of 2021, what we found was what we would call valuations at the high side of normal, really across the safety and growth spectrum. And you'll get where I'm going with this as I move along. But we what we found was that in effect, the companies that had lower growth, i.e., these more safety type companies that maybe had more stability around their earnings but lower earnings growth, were actually more expensive in our view relative to a cohort of companies that that we felt, while expensive, we had more conviction that they'd be able to deliver the earnings growth over 5 years that would allow them to quote unquote grow into these valuations. So that started, call it in late 2021, and through 2022, we used that weakness in the market as an opportunity. Obviously, in the first, call it 4 or 5 months of the year, around the reaction you saw, particularly around rising interest rates, you saw many of these companies, because of their growth exposure, have feel a very acute pain. And so we use that as an opportunity to lean into this technology exposure. And so, this is companies, that may not be actually effectively grouped in technology, but I think we could argue fall closely in that realm. ServiceNow would be an example of that here on this list. Salesforce, another name we added to. Amazon gets grouped in consumer discretionary, but obviously has a big piece of its business that is cloud services, and that's the biggest position in the portfolio today. And we've had an opportunity to lean into that weakness and continue to do so this year. And then even in communication services, you see a name like Netflix, which, if we were talking in the middle part of last year, very controversial name around seeing slowing subscriber growth globally. But what we've seen, and the view that we had, was that the company had this real opportunity to monetize the ad-supported model, which we're starting to see roll out, and as well as the issues that they've had around password sharing, really monetize that as well, and be a real driver of free cash flow on a go-forward basis. So, so I mention all that in order to say the technology exposure that we've had in the portfolio has grown in recent years, and we think that it's among some of the best opportunities on a go-forward basis. And again, I just want to separate that from maybe this broader comment around AI and how semis play into that, because that's not really an area that we've historically played in, given the cyclicality of semiconductors. And we still have, NVIDIA, just to finish the thought, NVIDIA is a great company, and we wouldn't debate that. What we would say, though, is we still question some of the elements of that business that might be a little more cyclical in nature. And when the growth falls, it falls hard and falls fast. And so for a portfolio like ours that's concentrated and seeks to really preserve and grow clients' capital, we're a little hesitant around a name like that. So hopefully that gets to the spirit of the question. But I'll turn it back to Luis and Elena and Eric, if you want to add, feel free.
Yeah, I might
Eric,
just add a little bit to that. I might
sorry.
I think that was. Oh, go ahead. Sorry, Elena.
No, I was asking you if you could, if you wanted to add something. So sorry to interrupt.
Yeah, no, sure. I've been doing this a while, and I'm just a few miles away from NVIDIA actually as we speak. Obviously, Scharf Investments, being more value oriented, tends to be under indexed to tech less than the Polen. However, I think it's really interesting to kind of look at some parallels right now in terms of the concentration of the market leadership in the U.S. Now versus the peak of the tech bubble, in the year 2000 when it started. And if you look at that, 6 of the 10 largest companies in the world in 2000 as it started, Lucent, AT&T, Cisco, Intel, Microsoft. I'm forgetting one. I think they basically were all kind of hardware or infrastructure oriented, except for Microsoft. Microsoft's the only one of the 6 that's still on that top 10 list today. And so, hardware, because of the dynamism of technology and the product cycles, it's hard to stay entrenched in your competitive position. Software used to be a software engineer with Accenture before I switched into this industry. The switching costs from software are so high that it gives a tremendous competitive durability to software versus hardware. And so I think NVIDIA is a really great company. They're shelling shovels in the AI gold rush. They're going to make a ton of money for a while. It remains to be seen, as Andrew said, the durability of that franchise. And the other thing to think about too, conversely, is that the market is acting like all current, whether it's hardware or software, kind of mega cap IT position businesses are going to benefit from AI. Typically, that's not the case. There's going to be winners and losers in every kind of technology revolution or evolution. And so it'll be very interesting to see what happens going forward. But I think that's why, active management is going to be particularly important going forward to try to discern who's going to benefit and who's not.
Okay, Eric, we have another question for you. Can you tell us, please, about which sectors do you think they show more attractive value according to which sectors are more attractive according to your value strategy, and how to avoid a value trap?
Okay, yeah, good questions. I think, what's interesting is that the market, while at the kind of market level is not really cheap, it's fairly expensive historically, particularly because interest rates are kind of higher for longer these days. Because of that concentration of leadership in some of these names, outside of it's not so bad. So, the S&P is closer to, for example, 19 times forward earnings, but equal weighted index, S&P 500 index is closer to 16. So that 3-turn spread is historically significant. What it means is that there are kind of relatively attractive opportunities across a lot of sectors. So I think rather than, what's most interesting from a valuation perspective, I think it gets back to this quality kind of theme of this presentation. What's more important going forward is what sectors are going to offer durability of earnings as the economy contracts or as that net profit margins normalize going forward. And I think, things like healthcare, where we have a larger overweight, are still interesting. Healthcare is still relatively cheap versus its history. There's always concern that in the U.S. market anyway, that U.S. healthcare is still a quasi-private public industry as opposed to the rest of the developed world, where it's primarily more of a public service. So there's always this threat, right, of regulatory change and its impact on margins within healthcare. But we think that it's really, pricing that discount in. So there's healthcare names in our portfolio that are priced at 10 to 12 times earnings, almost therefore half the S&P 500, with a much more durability, earnings consistency if things roll over. So that's an area that we really like. I think also this post-COVID normalization, i.e. this consumption mix shift from goods to services, still has legs. So things that are companies that are really square in that service area, that are still clawing back demand after having it deferred during the pandemic, are interesting, and you can get earnings growth going forward, even in a contraction period. And then in terms of value trap, what we typically do is we want earnings growth. It doesn't need to be the top kind of 10% tile, but it does need to be kind of top quartile. We do want 10% earnings growth. If a company can't deliver that, our feeling is that we're not going to get the classic, multiple expansion that we, like any other value manager, wants to see. So, for example, we own Cognizant, which was the thesis there was kind of a poor man's Accenture. They would kind of duplicate the Accenture playbook of taking free cash flow, acquiring kind of hot digital demand services, and effectively buy back shares, ramp up earnings per share in a very low risk way. But generally speaking, they just failed to do that because they were trying to manage profit margins versus their growth, and you just can't do that in tech services. So we sold it after a couple quarters of loss of market share, where the acceleration of the digitization of kind of offline industries really showed that they had not invested in that during the pandemic enough. And so we sold it after a couple quarters of market share loss. We sold Masco about a year ago. because of their exposure to the housing market. Even though the business was performing pretty well, it's primarily a low volatility industrial play, over levered to plumbing maintenance, and they own a company called Bear Paint, so it's painting, it's remodeling. Even though that was the case, we still felt that, given the extraordinary increase in mortgage rates in a short period of time, that they would be impacted in terms of forward growth. And so for us, it just takes a couple quarters of negative trend, and we're typically going to exit the portfolio, exit the name, even if the valuations look attractive.
Thank you. So before we wrap up, I would like to ask you a question. Since your strategies are not opposite, but it seems like they would work in different cycles. Like in 10 seconds, if each of you can say why growth, why value, and why in this environment.
Andrew?
Don't be shy. Don't be shy. It's not a competition. Luis said they're very uncorrelated, so you're fine. Andrew, okay, let's start with you.
Oh shoot, I can't hear you, Andrew. I'm not sure.
No. Okay.
Shoot, I guess I'll start while I'm just trying to figure out audio. So I think for us, for the value side, for quality right now, why value is there's still a very historical spread between value and growth. And typically it's about 4 or 5 PE turns spread. In terms of the average spread between the two. Right now, the number of PE turns is closer to 9. And so it does look like kind of the tech bubble where you had that giant spread. And so I think that's the case for value. I think the case for value, quality value is, cyclical value had a big reopening trade benefit. And so whether it was energy or financials, there's a lot of reflation of the economy of that sector specifically. And so those earnings that were very depressed came back. So cyclical rally is what led kind of late 01 and through much of 02. And so it's kind of lower quality in nature. I think going forward with the threat of an earnings contraction, you have to hit us for, I think a higher quality orientation is important. And that same goes for growth. And that's why I think whether it's growth or value, yes, it's important to understand that. But in all seriousness, I do think quality is going to be a much more important factor than just style.
And I figured out my audio. This was my fault. I just had myself on mute. That's all. Yeah, yes. I wish it was something more than that. Yes, as far as the growth side of things goes, I would just say we've lived, again, hearkening back to the points I made a little bit earlier. The past few years have been an incredible historical anomaly. And so what we saw last year was really on the back of so much pull forward demand that many of the companies we tend to own in the quality growth end of the spectrum felt. And so we feel that some of that growth as it wore off last year, as margins compressed last year, that it gave it came at the same time that interest rates were rising. And so you kind of had this 2-barrel effect of the discount rate going up and really taking PEs down, and then the optics around some of the COVID grow overs coming through. And so as we stand here at the beginning of, or I guess the middle of 2023, you have an opportunity to own these best-in-class businesses that are in a very good position to deliver growth on a go-forward basis at very reasonable valuations in a historical context. So we're very excited about that as we look ahead.
Great, perfect. So, well, I don't know, perfect. Luis, if you wanted to add something or?
No, thanks, Andrew. Thanks, Eric. Everybody, as you know, you can get in touch with us if you need any more questions from them or want to speak to either of them individually. And thank you, Elena, so much for.
No, thank you for being here. Welcome to Madrid. He just landed.
Happy to be here again.
So, well, thank you very much, guys. Thanks, everybody. And we'll see you soon in another Virtual Investment Summit. Have a great day. Thank you.
Thanks, everyone.
Thank you.